You finally start doing the right thing. Every month, you take a portion of your paycheck and lock it away in a savings account. It feels good. There is a sense of accomplishment in the discipline required to build that balance and secure your future. But then you open your banking app a year later. You have $10,000 sitting there, perfectly intact. But you realize the money hasn't actually done anything. The comfort you feel in that moment is deceiving. While stashing cash away ensures your money won't disappear, relying on savings alone often leads to long-term financial stagnation. Look at the interest rates banks currently offer. A typical modern savings account yields around 0.5% a year. This chart shows what that rate looks like in practice. If you park $10,000 here after a full calendar year, the bank rewards your patience with roughly $50. Compare that to the concepts that actually build wealth, ideas like compound growth and the broader stock market. These represent two different tools. Savings accounts are built to protect capital from loss. They are not designed to multiply it. Securing your cash is a necessary baseline, but treating a savings account as the final destination for your money is a primary reason many people never see their net worth truly grow. Consider the S&P 500, an index tracking the 500 largest public companies in the US. Historically, it has averaged a return of about 10% per year over long periods. Let's look at a comparative chart, starting with that same $10,000. After 1 year in the market, a 10% return brings the balance to $11,000. That $1,000 difference is a start, but for many beginners, it doesn't yet feel like a life-changing sum. The real impact appears over 2 decades. The savings account crawls to $12,200, but the invested money accelerates. Compounding year after year, it grows to over $67,000, leaving you with over $55,000 in additional growth. This chasm illustrates why long-term wealth is built by owners of assets rather than collectors of cash. If the numbers are so heavily skewed in favor of the market, why do so many people leave their cash sitting idle? It comes down to human emotion. A bank balance never drops on a random Tuesday, which feels deeply safe. Market investments move up and down daily, and that volatility can trigger a powerful fear of loss. Overcoming this fear begins by securing a 3 to 6 month cash reserve, an emergency fund. This ensures that if your car breaks down or you lose your job, you won't be forced to sell your investments to cover the bill. This foundation allows for a mental shift, separating your finances into safety and growth buckets. The growth bucket is allowed to fluctuate because its purpose is to expand over decades, not days. By drawing a hard line between the money you need for survival and the money you need for the future, the daily anxiety fades. You can finally tolerate the movement required to build wealth. The actual mechanics of building this portfolio start with habit rather than scale. Contributing $50 or $100 a month is a significant start because the goal is building the habit. True durability comes from ignoring flashy, high-stakes strategies. Day trading and crypto speculation often draw beginners in, but they increase the risk of losing the very capital you worked so hard to save. Instead, you can rely on index funds. Because these funds track the overall stock market, a single purchase gives you fractional ownership in hundreds of companies at once, spreading out your risk while capturing the market's growth. This straightforward approach is exactly what legendary investor Warren Buffett consistently recommends for the vast majority of people. Growing your net worth rarely requires extreme intelligence or a talent for timing the market. It requires a willingness to repeat productive, boring actions over very long periods of time. The final piece of the strategy is maintaining your discipline, keeping your monthly contributions steady regardless of the current news cycle. Think of it this way. Saving cash is like locking seeds inside a glass jar. They are safe, but they will never grow. Investing is taking the risk of burying those seeds in the dirt so they can actually take root. Naturally, you will wonder what happens when the stock market inevitably goes through a severe downturn. Long-term investors actually benefit from these drops. When prices fall, your standard monthly contribution automatically buys more shares at a discount, positioning you for significantly larger gains when the market recovers. While saving money gives you stability, the bridge to long-term wealth is built through the patient application of compound growth.